Welcome to the Deep Dive. Our mission is to take your source material, the dense articles, the financial reports, and the strategy documents, and distill the absolute essence of what matters. Today, we are deep diving into Isuzu Motors Limited. And this is much more than just a story about trucks. It's about a 100-year-old Japanese industrial giant aiming for a staggering 6 trillion yen in revenue by 2030, which requires, well, nothing less than a complete corporate metamorphosis.
That 6 trillion yen target is the headline, but the context is the real story here. Historically, Isuzu has been a fantastic but fundamentally cyclical hardware producer. They build metal boxes that move freight.
Right.
Their new goal, laid out in the IX plan, demands a structural shift. They want to become a commercial mobility solution company.
Oh.
We're going to focus on how they plan to pull off that transition, betting big on data, connectivity, autonomy, and electrification, which means fundamentally changing how they interact with every single customer worldwide.
Okay, let's unpack this. We are talking about one of the oldest names in Japanese commercial transport, founded a century ago, with origins in Umori, Tokyo. When you think Isuzu, you think durability and dependability, right?
Absolutely. Their identity is synonymous with rugged reliability in commercial vehicles, or CVs, and light commercial vehicles, LCVs. Their core stable of products is recognized everywhere. The heavy-duty Giga truck and the medium-duty forward truck, which dominate key heavy-duty segments. But the global engine of their success is arguably the one-ton pickup, the D-Max, which is manufactured primarily out of their massive hub in Thailand.
And that stable of products supports their very tangible core mission, to be the excellent company for CV, LCV, and powertrains that supports human life and social production activities. It sounds simple, but that mission is huge when you realize how dependent global supply chains are on their vehicles.
It is, and that scale is the platform for the IX plan. They maintain sales and, crucially, after-support networks in over 150 countries. That vast global footprint means they have this incredibly sticky, stable customer base, the foundation that lets them even attempt this massive, expensive transformation. It's hard to overstate the asset value of that 150-country service network.
And speaking of transitions, they marked this pivot symbolically, moving their headquarters in May 2022 from their historical Tokyo home to the high-tech Yokohama Gate Tower in Kanagawa, a physical move signaling they are trying to shake off the past.
A new physical location for a new operational model. And they needed that shakeup because if you look at their history in the early 2000s, things were not always smooth sailing. Domestic market shifts and overcapacity pushed their utilization rates down as low as 50% around the year 2000. That's a brutal metric for a heavy manufacturer, and it necessitated major painful structural reforms like the V plan and significant workforce reductions just to survive.
Those difficulties, though painful, set the stage for their modern strategy. In 2006, they dissolved their capital tie-up with General Motors. Was that breakup painful, or did it essentially grant them the independence they needed to innovate freely?
It was strategically liberating. Freed from the constraints of a major global partner, Isuzu could choose its own path and, critically, choose its own technology alliances. That independence started paying dividends around 2017. They launched improved hardware, the Giga and forward trucks, and simultaneously invested heavily in the data infrastructure, remodeling their commercial vehicle telematics service, known as Mimimori.
Telematics, that's the data backbone, the central nervous system you mentioned. That foresight allowed them to better navigate the volatility that hit around 2020, right?
Exactly. FY 2020 was rough. They were hit by trade friction and slowing Asian markets, resulting in a painful 20.5% drop in operating profit. That vulnerability to global business cycles is exactly what the IX plan is designed to solve. But even while dealing with that dip, they launched the full model change for the D-Max LCV, focusing on the concept beyond the pickup truck, showing they were still investing in the core hardware, which provides the revenue that funds the solution's pivot.
The acceleration since 2020 is remarkable. It proves they weren't just talking about innovation. They sprinted toward XEVs, or electrified vehicles. We saw FCV small hydrogen trucks co-developed with Toyota and CJPT on the market by 2023. And this past May 2024, they released Japan's first battery electric vehicle full flat route bus, the Erga EV.
That speed is achieved purely through smart alliances, which we'll get to. But the culmination of all this planning and investment was April 2024, the launch of the IX Midterm Management Plan. This is where they fully shift their rhetoric, committing the entire company to transforming into that high-margin solutions provider, leverage on the technology they've acquired and the telematics data they've been collecting.
Let's discuss how this transformation plays out globally, because Isuzu is incredibly exposed to world markets. Historically, over 60% of their sales have been overseas. That heavy globalization means currency fluctuations, especially the yen exchange rate, are a major critical risk factor, impacting everything from raw material costs to revenue translation.
That currency risk is constant. Their overseas strategy is definitely dual-focused. On one side, you have the LCV powerhouse in Thailand. They see the need to fortify that core manufacturing base with a massive 32 billion Thai baht investment into the LCV supply chain. That confirms that the reliable, profitable DMEX business is the cash cow intended to fund the expensive innovation strategy globally.
And then there are the market dynamics themselves. They're carving the globe into two halves. You have the advanced markets, North America and Australia, which are targeted as the launch pads for advanced services like e-vision and maintenance leases starting by 2028. They use the high demand and strong LCV reputation, especially in Australia, to test these new high-tech offerings.
Then you have the volume play, the global South India and Africa. This is positioned as the strategic growth region for sheer vehicle volume, aiming for 320,000 LCV sales there by FY 2031. However, I have to inject a note of skepticism here. Management itself acknowledged in a 2023 Q&A that these emerging markets are currently tough. That 320,000 unit goal is highly aspirational and subject to volatile local economies, meaning it's a high-risk volume target.
That's a necessary caution. But perhaps the most profound change in their overseas operation isn't the sales target, but the personnel shift. The sources detail a major organizational restructuring in the overseas CV division, moving half of their service personnel directly into the sales division. That feels like a radical change in corporate structure.
It is a radical change designed to force a cultural pivot. They are actively seeking song, a Japanese concept that translates roughly to breaking away from selling off. They don't want salespeople who just move a metal box and walk away. They want every client interaction, regardless of whether it's technically sales or service, to be focused on supporting the customer's full operational life cycle.
So the technician is now focused on maximizing the customer's vehicle uptime. They become an indispensable value provider instead of just a service contractor.
Precisely. It changes the nature of the relationship. It's a foundational shift from a transactional model to a subscription or solutions model, and that takes us directly into the core logic of the IX plan.
The structural pivot that requires a 6 trillion JPY revenue target and an operating profit margin exceeding 10% by 2030. That is an enormous jump. Let's talk about the investment required to bridge that gap.
Driver one is the financial scale. To hit that 6 trillion figure, Isuzu plans a total investment of 2.6 trillion JPY from FY 2024 to FY 2031. To put that in perspective, their historical annual capex has been significant, but this 8-year commitment is staggering.
And the most surprising figure is that 1 trillion JPY of that 2.6 trillion is explicitly earmarked for innovation investment case, DEX, EV, and autonomy.
Okay.
This feels like the ultimate strategic risk and leverage point.
It is the core strategic bet, and here's the hidden logic. Committing 1 trillion yen to future innovation clearly signals management's belief that their existing traditional business model selling only hardware is structurally incapable of generating the sustained long-term growth and high margins required to reach the 6 trillion yen goal. They're spending a third of their total capital budget to redefine who they are.
That explains the urgency behind Driver 2, the push for high-margin after-sales revenue. If the sales of new trucks are volatile, you need a stable recurring income stream to damp that cycle. How are they achieving this stability?
They are leveraging the domestic telematics expertise they built in 2017. We mentioned Mimamori. That's their advanced vehicle monitoring system, the central data platform. Built on top of that is Priesum, which is their sophisticated predictive maintenance layer. This data allows Isuzu to tell the customer, your truck is going to break down next week, let us fix it now.
Reducing downtime, maximizing uptime, that's the ultimate value proposition for a commercial fleet customer. And the financial goals for this high-margin recurring stream are concrete, which is what matters to investors.
Absolutely. The after-sales revenue is targeted to reach 600 billion JPY by FY 2027. This is revenue that is inherently higher margin and far less sensitive to economic cycles than new vehicle sales. They are actively globalizing this expertise, implementing maintenance lease services and proprietary tools like e-vision, which is an EV fleet planning and charging management program, in advanced regions like North America starting soon.
Driver 3 Autonomy and XEV shows how they are building a technological moat through strategic alliances, rather than attempting to become a software company overnight. They seem to recognize that they cannot compete with agile software startups.
That's the critical insight. Instead of spending billions trying to internally develop the autonomous control software, they are buying access and expertise. They invested $30 million USD in Gatic, the U.S. autonomous logistics company, and partnered with Tier 4 for autonomous bus development. It's a strategy of intelligent outsourcing.
And this rapid alliance building has a very specific goal: launching Level 4 autonomous truck and bus services in limited operational design domains, or ODDs, in Japan and North America starting FY 2028. For the listener who might not be familiar, what does operational design domain mean in practical terms?
It's essentially the defined conditions under which the autonomous system is designed to function safely. Think of it as a specific geo-fenced route, like a highway corridor between two logistics hubs or a dedicated factory yard. It's not full self-driving everywhere, it's self-driving where it matters most for commercial efficiency right now.
And their XEV approach mirrors this practicality, adopting a multi-pathway strategy rather than a blind sprint toward battery electric vehicles. This is clearly focused on the total cost of ownership, TCO, required by commercial customers.
Commercial customers are motivated by economics above all else. TCO means factoring in not just the purchase price, but fuel efficiency, maintenance costs, and residual value. This explains their dual FCV strategy. They are co-developing large truck fuel cell systems with Honda, targeting market introduction in 2027 because heavy-duty, long-haul applications benefit from hydrogen's greater energy density. But they are tackling smaller FCV trucks with Toyota where different power demands apply. They are matching the energy source to the specific job.
This massive capital expenditure commitment forces us to look at their financial discipline. How does Isuzu balance this colossal capex, that 2.6 trillion JPY total investment, with their commitment to shareholders?
They prioritize a stable and continuously growing dividend, which is classic Japanese corporate policy. We saw that consistency, with dividends moving from 43 JPY per share in 2023 to a proposed 49 JPY year-end dividend for 2024. Stable returns alongside aggressive growth investment is the message.
They're also highly aggressive on capital efficiency measures, specifically share repurchases.
Yes, they executed a major buyback of approximately 50 billion JPY, representing 3.4% of shares outstanding late last year, and subsequently canceled those shares in April 2024. That is management actively signaling confidence in their stock price and reducing dilution, balancing that investment splurge with capital return.
And finally, they've been proactive in what we call strategic asset recycling. They sold a stake in an associated company, IJTT, which generated net cash in of about 10 billion JPY. Crucially, those funds weren't just put into general operating capital.
They were explicitly earmarked for future-oriented innovation investments. Their policy is crystal clear: divest non-core assets, execute major buybacks to keep shareholders happy, and dedicate the proceeds to the high-risk, high-reward IX transformation.
We've seen that Isuzu is staking its future on this incredibly ambitious IX plan. 6 trillion yen revenue, 10% plus margins, and a complete strategic transformation by 2030. The entire enterprise rests on the execution of that 1 trillion JPY innovation investment and the successful pivot to high-margin recurring revenue.
The key variable is not whether they can produce the hardware or even acquire the technology, which they are doing well through alliances. It is whether they can monetize the data and after-sales services inherent in the connected truck ecosystem globally. This requires an organizational and cultural overhaul in 150 diverse markets. So the real question for you, the learner, isn't about their technology or even their massive financial target. It's about their human capital. Can Isuzu successfully transform its vast international sales and service force, literally hundreds of thousands of people from traditional product distributors into indispensable value providers, focused on maximizing customer uptime through data and service contracts? If they fail at that organizational change, no amount of hardware or software will get them to 6 trillion yen. That organizational friction is the single greatest determinant of success or failure.